Good evening, friends. Tax audit season is on, and we are once again with you on this Friday evening discussing tax audits. As you are aware, on earlier sessions, we have discussed the relevance of auditing standards and tax audit, some preliminaries for tax audit, do's and don'ts. Now we have started analyzing each clauses. Earlier, some clauses we have analyzed, and today we are going to deal with very important clause, that is clause number 21, which deals with several disallowances and allowances. And we're very fortunate that for the purpose of dealing with this particular matter, a person who is seasoned and practicing in tax arena and presently vice chairman of direct taxation committee, my colleague on central council, CA Piyush Chajed, has kindly consented to our request, and he is with us. So he will be explaining us what are various aspects which one needs to keep in mind while responding to clause number 21. And there are it is very important because whatever you report, maybe number of disallowances are coming out. So there the assessee will have to adjust his income depending upon what is reported. So the reporting, like in any clause, it has to be correct, but here it needs more than little attention. And this particular, these details along with whatever case law, etc., will be dealt with by CA Piyush Chajed. So I welcome Piyush Bhai to you. Chairman Raj Chawla ji is also here. From office team, we have CA Anita Sunija. So I welcome all of you to this edition of our tax audit on Fridays. And I'm sure that today you will have invaluable inputs as far as this particular clause is concerned. And I'm sure Chairman in his opening remarks will also talk about the recent publication that the TAQRB has brought about. That would be useful for your last minute quick preparation. So over to you, Chairman, sir.
Thank you, Chitle sir. Good evening to all. First of all, I welcome CA Chandrasekhar Chitle ji, my vice chairman of this committee and last year chairman in direct tax committee and my guru in direct taxation. I also welcome CA Piyush Chajed ji, my council colleague and expert in direct taxation. I also welcome CA Anita Suneja ji, secretary TAQRB, and other secretariat officers of our ICI. And I also welcome all the members attending this program. So, my dear fellow colleagues, I welcome you all in this very important webinar from the series of tax audit practice session 5. So, today it is our 5th program, and today our subject is commonly found irregularities in form number 3CD clause 21, as told by Chitta sir also. So today we are going to discuss the commonly found irregularities in the form number 3CD. As you all are aware, tax audit plays a vital role in ensuring compliance with tax law and regulations. They encompass an examination or review of the books of account of any business or profession maintained by taxpayers, thereby promoting transparency and fairness in the tax system. If I specifically talk about clause 21 of the form number 3CD, it is very important clause covering various sub-clauses thereunder. Continuing its effort to improve the quality of tax audit, TAQRB brings out this webinar series on commonly found irregularity in form number 3CD clause 21, which will help and guide members in enhancing and improving the quality of tax audit. For sharing the deep insight on the same, I would like to invite Central Council member CA Piyush Chajed ji, Vice Chairman of Direct Tax Committee, being the speaker for our today's session. I am confident that today's webinar will be a valuable addition to our professional knowledge. And as told by our Chitle sir, that our TAQRB is coming with this
quick reference, sir.
Quick reference, sir. Yeah, quick reference, sir. So very soon we will send to all of you. So with this, I invite CA Piyush Chajed ji for his topic. Piyush ji.
Thank you very much, Chairman sir. CA Dr. Raj Chawla, Chairman of Tax Audit Quality Review Board, my senior Central Council member, Vice Chairman, but we always tell him as always a chairman. He was also a chairman of Direct Tax Committee, of which I am a vice chairman. So for me, he will be always my chairman. C.V. Chitla sir, currently a vice chairman of Tax Audit Quality Review Board, chairman Ethical Standards Board, and doing numerous service to the institute. C. Anita Suneja, secretary to the TAQRB, tech teams, all the STM members, all the fraternity of the Institute of Chartered Accountants. Very good evening. It is my immense pleasure to be amongst you, and especially when we talk about tax audit or tax. Being also a vice chairman of Direct Tax Committee, both the committees, DTC and Tax Audit Quality Review Board, is actually equipped and is actually always feels that the members should be experts in the tax, and they should also look into it, the various pitfalls which may arise when they are doing the tax audit. As you know, that the audit is the most important areas of our profession. I would say it is a monopoly. You may be advising your clients on the taxation, you may be knowing a tax law, but that is different. When you are an audit, you actually step into shoes of the assurance. When you are doing an audit, you are not only serving your client, you are also responsible to various stakeholders who are relying upon that audit report. When you talk of audit of financial statements, you are actually responsible to various stakeholders rather than your clients. And therefore, your answerability, your responsibility goes far behind your tax knowledge per se. When you are doing a tax audit, your knowledge, it's very important that how you do an audit, how you actually report in those particular clauses, and you need to know the objectives of this tax audit also before you actually do it. I am very happy that TAQRB is doing this series and discussing a threadbare, I would say threadbare, in-depth study of a particular clauses. I know tax audit has been there in practice since 1984, 85, very early, or maybe 87. I do not recollect. And a lot of our members, 80% of our members are engaged in conducting tax audit time to time. But it is very important that you review it on an yearly basis. So before I go to that, I'll start my presentation on the screen. Basically, obviously, I am concentrating today only on clause 21. And the idea behind concentrating on the particular clauses is that we do a threadbare analysis of this particular section. I have started my screen shares. Obviously, the topic given to me was commonly found irregularities in form number 3CD, restricting myself to clause 21. I am aware that you have already discussed up to clause 20 in last 4 sessions, and now we are in the 5th session as mentioned by the chairman. So, of course, I'll take you, my presentation will include certain objectives of the tax audit. Because whenever I deliver a lecture on a tax audit, or whenever it is when the word comes audit, I always feel it is very important first to understand the objective audit. Even maybe it may be there may be a repetitions, you all would be knowing this, but it is very important to understand this. Thereafter, I will discuss clause 21's all subclauses running from subclause A, subclause B, C, and it will go up to clause H. We'll discuss it. What is the requirement, which is also coming from the guidance note? What are the various judgments which will help you in actually reporting or discharging your audit functions correctly? That's the most important. And before we actually discharge audit function, it is said that when you are doing a tax audit, there has to be a fair knowledge of your Income Tax Act also. So if I am reporting on a particular clause, obviously I have to read that particular section very well. I should know about it, number one. I should also read my guidance on what is expected from me while reporting in this particular clause. I should also be aware of the particular case laws on that particular section. It is very important that we are aware of on this. Then only we will be able to discharge our tax audit function. So with this, I will start my presentations. Good evening once again for being here. So whenever I start my presentation on tax audit, I always feel that it is always better to refresh what is the objective of the tax audit. I know everybody would be aware. So objective of the tax audit is examination or review of accounts of any business or profession carried out by taxpayers to ensure correctness of implementation and proper compliance of tax provisions envisaged under the Act, enables the tax authority for verification and assessment. Now, as I said, the tax audit was not in the statute since inception. Income Tax Act came into the latest Income Tax Act, which before that there was Income Tax Act 1992. Now the act which we rely came in 1961, but the tax audit 44AB provisions were not there in the statute every time. It came somewhere in 87 to best of my memory. Why did tax audit came in? We need to actually go into the objective, and that will help us. Before tax audit came in, the seniors may recollect that there was a compulsory scrutiny of all the income tax returns filed. So let's take an example. Even if any person was filing an income tax return, it was being compulsorily scrutinized by the assessing officer. It was scrutinized. The assessee used to file all the returns. It may be any income tax return. It may be a business return. It may be an individual return having only income from other source or salary. All those were actually being scrutinized. So it was felt necessary that whether such a level of 100% scrutiny is required, why not this responsibility? Ultimately, the objective of this scrutiny was to arrive at the correct income, which is to be brought to taxation under the Income Tax Act. So therefore, it was felt necessary that why not we have a third-party assurance from a chartered accountants who are the experts in the audit of the financial statements, and they can actually give us an audit report in the form number 3CD, and that is the background where the tax audit was introduced. You won't believe, after the tax audit came in, 100% scrutiny was stopped. The objective of tax audit is ultimately to derive at correct income of a particular assessee under the provisions of Income Tax Act. So that objective should be kept in mind whenever we are reporting on any particular clause, I would say. That the objective is ultimately, it helps the assessing officer, it helps the department, I would say, it helps the revenue to derive at the correct income under the Income Tax Act. So if I'm filing a return of income, and whether that is correct or not, or whatever financial statements which are forming part of the return of income are correct or not, can only be known to an assessing officer by scrutinizing it. So it was felt necessary during that period of time, rather than doing a 100% scrutiny, let it be verified and let it be assured from an chartered accountant who is an expert. He will do an audit of the financial statements, and he will do a reporting in a particular format, which is on an important clauses which are relevant for determining the proper income or a proper computation of income. So that is an objective of tax audit which needs to be kept in mind whenever you are reporting. Obviously, our responsibility is to express opinion on the financial statements. The Form 3CD is accompanied. There may be a situation where you are doing a tax audit for a firm's partnership firm, which otherwise is not required to carry out an audit of its financial statements under any particular statute. But because he falls within the limits prescribed under Section 44AB or maybe any other particular section, I'm not going into those particular sections, he is required to do an audit, and he has to issue an audit report in form number 3CA, 3CB, or 3CB as may be applicable. So 3CA for the companies, 3CB for other than companies, and 3CB is an annexure to 3CA and 3CB. He has to issue an audit report in that. And when we talk of an audit report, obviously you need to express an opinion on the financial statements which are formed. That is what it is all about. And the audit has to be conducted in accordance with standards issued by the ICA. So if anybody wants to express an opinion on financial statements, let's take an audit report is issued under the Companies Act, or you are issuing an audit report for any other particular firm and not issuing a form 3CA, 3CB, or 3CB. You have to ensure that the audit is conducted in accordance with the standards issued by the ICA. If you are doing similarly a tax audit, you should be aware of all the standards issued by the ICA, because those are relevant for the audit of any financial statements or any audit report which you are going to issue. As a part of these standards, obviously, you need to obtain sufficient and appropriate audit evidence. So whatever assertions you are making, whatever reporting you are doing in Form 3CD, you should ensure that it is properly evident with the supporting documents. That is where it is documentation of the audit records is concerned. Whatever you do, you may have verified, for reporting in a particular clause 21, you have verified various ledgers, but ultimately those evidence, your documentation should speak. And therefore, it's always I reiterate that the standards issued by ICI should be followed, irrespective whether you are doing tax audit, whether you are doing audit of the financial statements. To verify the statement of particulars required to be filled under Section 44AB, that is the Form 3CD. So you have to verify all the statements which have been statements or the reporting requirements in the form 3CD, read with form 3CA or 3CB, and that you have to verify. So when you do a verification, you are aware that institute has come with guidance note on audit of on guidance note on tax audit. You should please refer to it. Whatever it is, what are the procedures to be followed, that should be put in. So now coming to the clause 21, there are various clauses I mentioned earlier. Clause 21 has subclause A to subclause H, and again subclause A requires you to report furnished details of amounts which are debited to profit and loss account, and they are in nature of items mentioned in subclause A of clause 21. So you need to actually give the details of this. Now, of course, it may sound it very simpler, and I've seen it. The people who are actually doing a tax audit take it in a very lighter way. And I have seen this particular clause 21 subclause A very specifically. Hardly any information do come in. At the TAQRB, I know the chairman, vice chairman would have a better experience, because TAQRB is now also reviewing tax audit reports issued by the various firm of chartered accountant, and they would be also issuing advisory after verifying that whether they have verified, whether they have reported on the clauses wherever the reporting requirement was there. And it has been felt that at a lot of times when actually I speak of this subclause A, the reporting do not happen in this particular case. So it's very important that you be serious about it. You look into a guidance note. It should not be taken lightly. And because of that, I wanted, and when we were discussing with chairman and the vice chairman also, it was felt that let us do a deep dive series. This is something sort of deep dive series, wherein we are only discussing clause 21. Generally, 1.5 hours, you discuss the complete intricacies of the tax audit, discusses the important points and important issues. Sometimes you may feel that 1.5 hours only for a particular clause 21 days might be a boring. How much depth in that I need to go in a particular clause for that matter. And when we have a lectures which institute conduct, maybe in a whole day lecture wherein you cover whole of the form 3CD, or you may have only a particular subclause wherein you actually have a 1 hour. Sometimes I felt that in 1.5 hours also, the intricacies or the important points of the tax audit are covered. So it's very important that you need to actually look into this particular clause. So when I'm doing this presentation, please keep it in mind when I talk of, let's take an example under the subclause A, if I'm talking of capital expenditure. What I will be doing is I will be actually covering what is the reporting requirement, number one. What is the expectation from the auditors? That is, what is the extracts of my guidance note, number two. What could be the pitfalls based on the certain judgments? So I have put a lot of trust on the judgments on the capital expenditure. Why I put a trust on the judgments is, it's not only important that you should be aware of those judgments when you are actually reporting it. So let's take an example. There may be a dispute between what is capital expenditure and revenue expenditure. And these judgments can act as a repository. All these judgments may be it may be available in the guidance note, may not be available in the guidance note, but the guidance note generally gives you the procedure to be followed when you want to report into a particular clause. So if I want to report in column 1 of capital expenditure on the screen, what are the steps I should as an auditor take? What are the judgments in this regard? I think so that should be briefed up. What could be the pitfall? So wherever I feel that there is a pitfall, or there could be generally, as per my experience, auditors are not actually looking into this aspect, I'll try to pinpoint that. I'll try to make a mention of that during my speech. So the first subclause 21, subclause A, which is the heading is very important. Please mind it. Clause 21A says, please furnish the details of amounts debited to profit and loss account, being in nature of so and so forth. It may be capital expenditure, personal expenditure, advertisement expenditure, in case of political party, expenditure incurred at clubs, bin entrance fees and subscriptions, then for providing services, then in nature of penalty. So only those expenditure which have been debited to a profit and loss account and are in nature of capital expenditure. Now the question may arise. Let us go to, I'll go clause by clause, subclauses I would say. Let us take in capital expenditure very first. Now, very important, why capital expenditure? Now, what is there to discuss on it? So if a person of a common man would wonder that amounts debited to a profit and loss account. Why a capital expenditure would be debited to profit and loss account? It is capitalized. It directly forms part of your balance sheet. It is not debited to profit and loss account. And generally, why this reporting should happen over here? So that is what this clause requires. That if any expenditure which is otherwise in nature of capital expenditure, as per the professional skepticism applied by the auditor, or as per the judgments available in the public domain, if the auditor feels that this is in nature of capital expenditure, but debited to profit and loss account, then you need to report over here. Let's take an example. It does not come if it is a capital expenditure, and as an auditor of the financial statements, you have already capitalized it, then obviously there would be no reporting of those figures in this particular clause. But then why there is so much discussion required on this? See, the most important, when I go to a capital expenditure, generally, as you are aware, that capital expenditure is not allowable in computing business income unless specifically provided any sections of the Act. So there are specific sections where a weighted deduction is also allowed, like 35(1)(2) if you are doing a scientific research, which says that the capital expenditure incurred would be also allowed as an expenditure. It would be treated as revenue for the purpose of allowance. 100% allowance would be done. That is 35(1)(2). Somewhere you get a weighted deductions also, 125%, 150%, 175%. So otherwise, if Act specifically provides for the allowance of the capital expenditure, then only it is allowable. Otherwise, yes, everybody knows capital expenditure is not allowable. It has to be capitalized in the books of accounts. Obviously, your responsibility as an auditor is to see that the financial statements are also true and fair. They are true and correct for that matter. And whatever is in nature of capital expenditure, ideally should have been already capitalized in the financial statements. And if that has been done, then there would be no reporting under this area. But there may be a situations wherein because the financial statements are ultimately of the management, they may not agree to your assertion. Let's take an example. I have purchased a computer software, and there is a view of the management that this is a revenue expenditure, so I will debit it to profit and loss account. But the auditor feels, based on certain judgments, based on the test which is required to determine, I feel that this is a capital expenditure which management is not accepting. So you certify your financial statements, but you need to report in response to this particular clause. So this amount which is otherwise debited to profit and loss account, I have purchased a tele software for an example. I'm not saying tele is a capital expenditure. I'm not saying for that, but I'm just giving an example. You purchase a tele software, which is a very simpler and which is used by the large. That's why I'm giving this example. The value may be 5,000, maybe 10,000 particular amount only. But you find an opinion that this is a capital expenditure. But the management says, no, sorry, it is a revenue expenditure, because there is unfortunately no definition available between what is capital and what is revenue, either in the Income Tax Act or any other law for that particular matter. And therefore, the importance of this clause is very high. It is a professional skepticism which is required when you take a judgment, whether it's a capital expenditure or revenue expenditure. There can be a difference of views for a particular item. Just I was discussing the software. And if you are of the view based on the various tests to determine whether this is a capital, that this is, yes, it's a capital expenditure, then you will have to report in this particular case. There may be a situation if you feel it's a capital expenditure, the first course of action should be, you should try to convince your management that please capitalize in the books of accounts. So there would not be a reporting. So ideally, your financial statements are drawn after in consultation with the auditor. There won't be any difference of opinion, and there may no reporting arise in this particular clause. But it may not be in all cases. Revenue may have its own views on it. They may say, no, sorry, there is no enduring benefit. I don't want to capitalize it. It has to go to the revenue. Then obviously it has to go to the revenue. So there can be two views possible. So if there are two views possible, then the reporting in this particular clause is happening. Now, whether it's a capital expenditure or revenue expenditure, there are various tests to be determined. Now, this test needs to be kept in mind. Please, generally, I've seen it for all revenue expenditure. Obviously, you will take your profit and loss account, look into the various heads of expenditure. You may do a sampling based on the value of the amount, and then actually look into those invoices, apply this particular test that whether they are in nature of capital. And if you feel that they are in nature of capital, then only you would do a reporting. There may be a situation, let's take an example, that you are not the auditors of financial statement. Let's take an example of a company where I am a tax auditor, but the statutory auditor is some other auditor. Statutory auditor was of the view that this is a capital expenditure and he has capitalized was of the view is a revenue expenditure, and he is charged to profit and loss account. Obviously, while charging, he would have taken a view. He would have documented those particular view, which can help you in also deciding as a tax auditor. So you may review those documentation also. You may look into the opinion of the statutory auditors also. You may look into the opinion of the management also, that why they have decided. But as an independent auditor, independent tax auditor, if you still feel that though it has been debited to a revenue, but it is in nature of capital expenditure for the purpose of the Income Tax Act, you may report in this particular clause. And if you're still not satisfied, you may also invite an attention in the main audit report, that is 3CA, stating that though in a profit and loss account, this has been capitalized, but I will report it in the revenue expenditure. Obviously, generally a qualification does not arise, because 3CD is also your tax audit. You don't have to go by the what management says. There cannot be a situation you do not report in the 3CD, but you qualify in the 3CA. That's what my view is. Because that's my audit report. 3CD is ultimately an annexure to 3CA. If you feel it is a capital expenditure which has been done no P&L, you have no choice but to report it, irrespective of what happens into while the assessment happens. While the assessment, it may happen that the assessee may tomorrow win the case also. The courts may take a different view. But today we need to apply professional skepticism based on the available information. So I would just like to go into the various case laws available for determining revenue and capital expenditure, which will give you an idea that there could be a difference of opinion. There could be a difference of opinion between a statutory auditor and tax auditor. If I am doing statutory as well as tax audit, that difference may not arise. But I've seen that once the books once there is a capitalization been done in the books of accounts, generally a tax auditor, even if it's a different then the statutory, he tend to agree with that particular view and he takes that particular decision. But please believe that itself is not an important criteria. There may be a situation where the auditor may have come to a conclusion, yes, this is a revenue expenditure. If I'm not taking it to revenue, I'm capitalizing, my profits are not correct. I have to go with the correct profits to the stakeholders. I am a listed entity. Profits will actually shake the markets itself. And therefore, he could have taken a very conscious call that I cannot take a chance. And this has to be a proper review. That itself does not mean that under taxability, there cannot be a different view. That could be a different view. So your duty is to report. At the same time, even if you are reporting, that does not mean that it has to be disallowed. If the management is of the view that though tax auditor has reported in subclause A, I do not agree to that particular. It's a capital expenditure. It's open to dispute it. No doubt, if there is nowadays, and 143(1), it has been seen that if you are reporting under this particular clause, but there is no disallowance actually happened in the computation, then the adjustment is happening in the 143(1). So you have to be aware of this particular fact also, and that's management to decide. As an auditor, I need to take an independent. So before I go on that, what are the tests to determine whether it's a particular item is of expenditure of capital nature? See, for determining capital nature, there has to be an existence of an asset or advantage of enduring benefit. So if the software is, I have paid a software only 1 year license, then obviously whether that fee is paid for obtaining a license of a software over 1 year gives me an enduring benefit. So any capital asset should have an advantage of enduring benefit. It should be referable, whether it is referable to fixed capital or fixed asset, in contrast to circulating capital or current asset. So whatever asset I'm buying, it actually is a fixed capital or a fixed asset for me, or it is like a current asset for me. Whether it relates to basic framework of the assessor's business, without which the business cannot be carried out. Whether it is expenditure to acquire intangible assets. So these are the important tests which needs to be determined, which needs to be kept in mind. It is also further important that whether any expenditure incurred by an assessee in any assessment year is an expenditure of revenue and leads to the following conclusions. So there are various conclusions based. What I've tried to do is I've tried to summarize based on the various judgments of tribunal, high courts, and the Supreme Court. That what could be the important test to determine whether it's a capital or revenue. So if the expenditure is for initial outlay or for acquiring an asset, obviously, I think so there is no doubt. Or if it is giving an advantage of an enduring benefit to the business or for extension of the business that is going on or for substantial replacement of existing business, it would be treated as capital asset. Please keep it in mind, word substantial replacement. If it is not a substantial replacement, whole machine is not replaced. Only I am replacing a small part. which does not gives me any enduring benefit. It only makes, if a small part is maybe a small, it's an air conditioner. I'm replacing an air conditioner. It is a capital asset. If I only replace a thermostat, it is not. But if I completely refurbish air conditioner, thermostat, everything, all the aluminum bodies, outside body, it's as good as acquiring an asset. It amounts to a substantial replacement. So if in a machinery, all your particular part is replaced, and it does not amount to a substantial replacement, so the professional judgment needs to be applied. However, because if only small replacement is happening and it is only helping in running of the business, then it is a revenue expenditure. Though for working out asset with a view to produce profit, it would be a revenue expenditure. Similarly, the another test could be if the expenditure is related to conduct of the business and forms an integral part of profit earning process operation and not for the acquisition of the asset, the possession of which is a condition precedent for running of the business, then it would be treated as a revenue. So it's very important for part of profit earning process. It does not give any enduring benefit. It does not increases your profit earning capacity. It is to maintain the same levels of the profit. It is a revenue expenditure. Expenditure incurred to acquire item of intangible assets like special knowledge, technical know-how, nature of or as a limited period, but not used as an asset or advantage of enduring knowledge. And at the end of the agreed period, that advantage or asset reverts back to the giver. So it's a temporary licensing of an intangible assets. That is a revenue. Expenditure incurred for a capital asset, immaterial, whether the price is paid. As I said, price is not important. So if I'm buying a particular software, which gives me a license for 100 years, though the value may be 10,000 rupees or maybe 5,000, that could be a capital asset of 5,000 rupees also. So price is not relevant to determine capital expenditure or revenue expenditure. How the price is paid? Only because I'm paying the price of particular asset in an installment, that could not be a criteria to determine whether it's a capital expenditure or revenue expenditure. And life of an asset is also not important. Let's take an example. If the capital asset is in nature of a short-lived one, expenditure incurred over it does not for the reason cease to be a capital expenditure. So if an asset, the general life of an asset is only say 2 years, that cannot be a criteria to determine whether it's a capital expenditure or revenue expenditure. That could be an asset with a short life. You may capitalize it and you may depreciate everything in the 1 year itself, if the life is 1 year. So these are the three important things like price, manner of the payment, the life of a particular asset cannot be a determining factor for determining whether it's a capital expenditure or revenue. It is not the law that any expenditure incurred for obtaining enduring advantage should be treated capital in nature. If the advantage acquired is to get the stock in trade of the business, then it would be treated as revenue expenditure. So if I'm buying an asset which gives me an enduring advantage, but as per the trade of business, it was acquired as a stock in trade. So I may buy a machinery, but I'm a trader in a machinery, so I cannot be a capital expenditure. Machinery is generally a capital asset. But for a person who is trading in a machine, obviously it's a stock in trade. So there's no question of capital expenditure. Then there are certain judgments which needs to be kept in mind. Please keep noting, we need to look at each revenue stream which has been debited to profit and loss account and test it with the various knowledge, whether those are in nature of capital expenditure. Expenses for expansion and diversification of new project is not a capital expenditure. So it's only an expansion and diversification. It is a revenue expenditure. That's a judgment of Punjab Haryana High Court. Purchase of second-hand machinery for use of its part to maintain existing machinery. So there's no new machinery coming in. You're purchasing a second-hand machinery, which is very important to maintain the existing machinery. Otherwise, the even existing machinery cannot run. It's a revenue expenses. Expenditure on voluntary retirement scheme is a capital expenditure. Expenditure on upgradation of computers is a revenue. So you are upgrading the computers, you are not changing the computers. Please mind it. That's a Madras High Court judgment. If you scrap the old computers and bring in the new computers, it is a capital. But if you're upgrading the computers from i3 to i4, i4 to i5, you are only upgrading that particular chip. It is a revenue expenditure. Expenses incurred in purchase of software components is to be treated as revenue expenditure. So you're only buying a particular software component, not buying a complete software. I'm not trying to make a point that if you're buying a particular software, complete software also can be a revenue expenditure. Let's take an example. There are two views I would tell you when a person is investing a huge amount in migrating to a SAP, like a SAP software, there are judgments to that effect. Even buying of a software, it only helps you in proper functioning of the business. It does not increases the profit earning capacity. What is important, whether it is increasing the profit earning capacity. So if you are installing a SAP and you are spending 10 crores for it, that itself does not mean it's a capital expenditure, unless and until it actually increases the profit earning capacity. So you need to test it based on each and every fact. Capital expenditure cannot become revenue expenditure simply on the reason that it was incurred in connection with business activities, which ultimately resulted in efficiently carrying on day-to-day business. So even if, because it is like, there was an example of SAP which I give. So there are two views on it. If I take a SAP, it only actually increases efficient carrying of day-to-day business. It really does not increases the profit earning capacity. So whether it can be a capital expenditure or a revenue expenditure, there could be two views to it. Thus, the question of voluntary involuntary payment is not material for determining capital revenue nature of expenditure. Therefore, High Court was justified in holding that betterment charges paid was a capital expenditure and thus disallowable. This is a Supreme Court judgment. The nature of receipt in the hands of recipient is not a determining factor to decide the nature of payments in the hands of payment. So what a recipient to who is selling me this particular asset, what is the nature of receipt in his hands could not be a determining factor to decide in the hands of the payer that whether it's a capital expenditure or revenue expenditure. You have to test it in the hands, from the hands of the payer if you are the auditor of the payer. Capital expenditure of certain types we have already discussed, scientific research under section 35. So though it is a capital expenditure, it is a deductible. So all the capital expenditure is not disallowable. Capital expenditure unless it is allowable under the particular provisions of the Act, like section 30. Expenditure on designing, layout and other temporary constructions, again not a capital expenditure. So even an enduring benefit, now this is a judgment of Supreme Court that says even an enduring benefit is not a conclusive test. So now it's becoming confusing. At one says that at one point the test to determine is whether there is any advantage which gives you an enduring benefit. If it gives an enduring benefit, there could be a capital asset. But the Supreme Court has said that that is not a conclusive test. That is only one of the tests. So there could be various other factors which needs to be looked into it, which we have discussed in last 15 minutes. There could be, you have to apply all such tests, and then based on your professional skepticism, you need to take a decision. Whether an expenditure is made not only once and for all, but with a view to bringing into existence an asset or an advantage for the enduring benefit of a trade, that is very good reason for treating such expenditure as properly attributable not to revenue but to capital expenditure. So enduring benefit could be one of the very important tests, but not a conclusive test. Once for all payment test is also inconclusive. Any item of disbursement may be regarded as of a capital nature when it is relatable to a fixed asset or a capital, whereas a circulating capital or a stock in rate would be treated as revenue nature. We have already discussed in my first slide. Treatment of books of account is not relevant. As I mentioned earlier, if an auditor, statutory auditor is different and he has already treated it as an expenditure, as a revenue in nature, whether and can be claimed as a deduction under facility, regardless of treatment given to state expenditure and assesses books of accounts. So you may come to a conclusion. Let us take a reverse case. You have capitalized in the books of accounts of the statutory auditor. So there is no reporting which is happening under 21A. You report when it is debited to P&L account and you feel it is a capital in nature. Let us take a reverse scenario. It has been actually capitalized in the books of accounts, but as then you are a tax advisor to the management and you feel this is the nature of revenue expenditure which should be otherwise allowable. You can claim in your computation of income. So there's a judgment to that effect, and there's a Delhi High Court judgment which I mentioned in the last bottom of my slide is Gaja Advisors, wherein it is held that only purely because it has been capitalized in the books of accounts, the basic nature does not change. That could not be a conclusive. If it is a revenue in nature which is otherwise allowable under section 37, it would be allowed. So ultimately, after so much discussion, what I was trying to make a fact that please keep it in mind all these facts. You need to apply your professional skepticism. You need to go through your auditing standards. You need to verify each and every, and keep this all in mind when you want to actually report in this particular course. I have seen it that generally such audit procedures are not being followed when we are reporting in clause 31. And sometimes whatever is debited into profit and loss account as a revenue, we feel that those are revenue of nature. So you need to do a sampling. I would say you can go based on the material figures which have been debited to profit and loss account. Look into those figures. take it out, verify the contracts, verify the use of that particular expenditure or an asset which has been applied out of that, whether that is creating any advantage of enduring benefit. So it all depends upon each and every facts and circumstances of each case. You need to keep this 5 important points, namely based on which it will be decided whether it's a capital expenditure or revenue expenditure, irrespective of treatment given in the financial statements. So main important is what is the quality and the quantum, position of the parties, objects of the transactions, and impact on the business. So if I'm acquiring any particular asset, what is the object of that particular asset? And what would be impact on the business? Whether it will increase my profit earning capacity, nature of the trade, and purpose. These are the important. So the cumulative effect of each factor by itself, of all the facts and circumstances, would afford the prime guiding factor. That's what Supreme Court says. There's no concept of deferred revenue expenditure. Please mind it written under the Income Tax Act. It is either a revenue expenditure or a capital expenditure. There is nothing, if it's a revenue expenditure, it would be allowed in the first year itself. You cannot say that I will claim 20% unless there is a very specific provisions, like the preliminary expenses, which are allowed under Section 35D, 20% in each year over a 5 years period. That's a very specific loss. Otherwise, there's no concept of deferred revenue expenditure. You made, of course, there's no deferred revenue expenditure now under the Schedule 3, I believe, to best of my knowledge. But still, if you are debiting it to, if your P&L, if you are debiting it over a period of 5 years also, but under the tax audit, under the Income Tax Act, you can claim it in the 1 year itself if you feel that it is a revenue expenditure. So, moving from the capital expenditure, obviously, now I would move to the next slide is in relation to second item is personal expenditure, which is again very important. Of course, again, a view would come, whenever I report in 21st clause, anybody would say, if I'm an auditor of financial statements, how would I allow personal expenditure to be debited to profit and loss? But I agree. As an auditor, you should not allow. But let us presume, we are going with a presumption that, yes, profit and loss account may contain certain amounts which are in nature of personal expenditure. And therefore, the reporting in respect of this clause is certified. The personal expenses are in nature of debited to P&L. So what does this clause requires? That any personal expenses which are debited to P&L are to be specified under this subclause, as they are not deductible in the computation of total income under Section 37. 37 is the general expenses, which is any expenses which have been wholly laid out for the business is otherwise allowable under 37. But the personal expenses are not allowable. So you need to verify each and every profit and loss head expenditure. And that's why when we say that whether the expenditure has been incurred for the use of the business or not needs to be tested. The auditor needs to verify each and every profit and loss expenditure. Of course, on the sample basis, I'm not saying sampling is always incalculated in audit. Nobody can do an 100%. It all depends upon the size, materiality factor also. But it does not mean that based on the sample, you do not cover each and every type of transactions. You should cover each and every type of transactions. Personal expenses include, what does the Supreme Court say? Personal expenses include only expenses on the person of assessee or to satisfy his personal needs, such as clothes, food, etc., or for the purposes not related to business. Now, this is very important, wherein I may have a different view and there are different views which have been taken, for which the deduction is claimed. Every expense to discharge a personal obligation does not become a personal expense. So you may discharge a personal obligation that does not become a personal expenditure. So it has to be not related to business. Then only there may be something which may be related. Let's take an example. In case of the company, I make certain payments on behalf of the employees, but that can be treated as personal expenses. For me, it is a staff welfare expenses. I would have paid for the clothes of the staff. For me, it cannot be a personal expenses in case of the company. I would also invite your attention to your judgment of very first on my screen right now, Sayaji Iron and Virginia. That's 253 ITR, Gujarat High Court, wherein it has been held that company cannot have personal expenses because it is an artificial entity which does not have personal needs, and thus use of vehicle for directors cannot be treated as personal use by the company. So let us take an example. I have given a vehicle to a director who is an employee director. So he uses the vehicle. Obviously, the certain personal usage of that vehicle cannot be ruled out. But it is part of my terms of contract. And for the purpose of the company, they cannot be treated as a personal expense. It may be a personal expense for a director, but it may be a perquisite in the hands of the director. it may be a benefit accruing to a director, but if you see it from a company's angle, it cannot be a personal expenses to a company. So if you are doing an audit of a company, there could be a situation where we can come to a conclusion that there is no personal expenses which have been incurred in case of the company, because company cannot have any such personal expenses. Though there is also required to report under the Companies Act. Your audit report specifically says that any personal expenses debited to the company's profit and loss account needs to be reported in your audit report. So if you are reporting any personal expenses over there, the question may arise whether a reporting in the Form 360 should be done. According to me, if you are reporting over there, obviously a reporting should be there. Whether it would be allowable or disallowable is a different issue. That's a management's view. Of course, my view would be it may be allowable as an expense, because there is a judgment under the income tax law wherein it is held that a company there can never be a person, but there could be a non-business use. And if it is a non-business, then it may be disallowed under section 37(1), but a company there cannot be a personal expenses. So you should not go into that I will do not report. If it is in a nature of person, irrespective of it being a company, you may actually report under this particular clause. Therefore, the management may not actually add it in his computation of income. It's a management's prerogative. Gifts on the marriage. Whether the gifts given on the marriage to the families of the directors of the company with which the assessee has business dealings, friends, and relatives cannot qualify as a business expenditure. So even if it is not a business expenditure, which I call all non-business expenditure does not become personal expenses. There could be a non-business expenditure is also not allowable. Personal expenses are also not allowable. But there could be an expense which is a non-business expenditure but does not fall within the personal expenses. The question arises whether I need to report into this. According to me, there may not be a requirement of reporting. But the idea behind the reporting, objective of reporting is that there has to be a proper disallowance. So in case you feel that this is a non-business expenditure, we could still report under this, because ultimately idea is to help the management and the assessing officer to determine the correct income. So I'm not going purely on the words. Personal expenses is different under the law and non-business expenditure is different. But when you see the objective of Form 360 is to derive the correct computation of income. And if in your view, if you are taking the view, yes, this is a disallowable expenditure, it's a non-business, it may be reported in under this particular clause, but actually making a disclosure in your observations in Form 3CA or 3CB also stating that these are not a personal expenses, but these are non-business expenses, and therefore we have reported in this particular. It will help in the management when they are preparing computation to disallow this. So it also, you are doing an you are discharging your obligation towards the client and actually bringing it to them that this is not allowable expenditure because it is not a non-business. It's not used for. It's not for a business expenditure. Treatment of human body part. Now this is a judgment of Bombay High Court and also Delhi High Court. Expenditure incurred on assessee's heart surgery was not an expenditure incurred wholly and exclusive for the purpose of his profession. So this is a case of a lawyer and a doctor who said that without if I'm not alive, I cannot practice the profession. So this should be allowed as this is not a personal expenses. So it has been ruled out. Even in case of chartered account, if I'm doing a heart surgery, I would say without heart surgery, I would have not been alive and I would have not done the audit. So this is an important part. So it's not a personal, it's not a non-business, it's a business. That is a judgment against it. So it remains a personal expenditure. The important test which section 37, we are dealing with section 37 because if the expenditure is otherwise allowable, otherwise disallowable. But 37 says that any expenditure which is claimed under section 37 should be laid out and expended wholly and exclusively for the purposes of the business or the profession. Wholly and exclusively. This expression does not mean necessarily. Ordinarily, it is for the assessee to decide whether an expenditure should be incurred in the course of his or its business. Such expenditure may be incurred voluntarily and without any necessity. And if it is incurred for promoting the business and to earn profits, assessee can claim deduction even though there was no compelling necessity to incur expenditure. So when it says wholly and exclusive, the businessman has to take a decision that this expenditure is wholly and exclusively necessary for the business. Necessary does not mean even a voluntary expenditure incurred would be allowed if it is towards for the purpose of the business. There are various judgments which says that commercial expenditure of that particular business is best left to the judgment of the assessing. And the assessing officer cannot step into the shoes of it. As an auditor, if you feel that it is a non-business expenditure, you also need to apply your professional skepticism to it. The word wholly refers to quantum of expenditure, that total expenditure should be incurred. And the word exclusively refers to the motive, objective, and purpose of the expenditure, and gives jurisdiction to taxing authorities to examine these matters. You may look into these matters as an auditor. I may also look into it, that whether this is wholly and exclusively for the purpose of the business. Then there are various other judgments. I'll just go through these judgments to determine, which will help you in determining when you are answering to this laws, and keep it in mind. This needs to be kept it in mind whenever you are doing it. It's only for, not actually, it helps in writing your audit report when you are writing it today, but it needs to be kept in mind when you are actually doing an audit of it. Business for which expenditure is incurred must exist during the relevant year. If the business is discontinued, it is not allowable, and therefore the reporting may come under here. However, when more than one business carried on by an associate are found to constitute one and the same business due to interlacing, interconnection, and one of them is closed, the expenditure in relation to such closed business is deductible from the profits of running business. A very important judgment which needs to be kept into the mind. Things done to cut down the losses when the business is still running are for the purpose of the business. Test to determine. I'll just have some water. Yeah. Things done to cut down the losses when the business is still running are for the purpose of the business. Test to determine whether the expenditure laid out and expended wholly and exclusively for the purpose of business. Once it is determined that the expenditure does not bear the characteristics of capital expenditure or personal expenses of the assessee, the first question arises as to whether it is laid down, out, or expended wholly or exclusively for the purpose of the assessee's business. So these are the various judgments on this. Please keep it in mind. It is irrelevant on whether it was compulsory for the assessee. So there may not be any statute which requires this expenditure to be incurred. But if there is a commercial expediency, it is a business expenditure. It cannot be termed as non-business expenditure or a personal expenditure. Commercial expediency, there are judgments to effect. As I said earlier also, it is best suitable to the assessee. Assessee has to decide that what is commercially expedient for him to incur the expenditure. True trust of an expenditure laid down wholly and exclusively for the purpose of trade or business is that it is incurred by the assessee as incidental to his trade for the purpose of keeping the trade going on and making it pay, and not in any other capacity than of a trader. So it should be towards the trade, it should be incidental to the trade. Connection between expenditure and purpose must be the real. It may be a voluntary, which is ultimately designed to further the objects and purpose of the assessee, can be treated as business expenditure, so long as the connection between the expenditure and object is real and not remote and elusive. It will be allowable. I've already discussed there are various judgment of Supreme Court, old judgment 65 idea 1967, commercial expediency to be adjudged from the viewpoint of a businessman. So there may be an issue that when you are actually stepping into the shoes. So an auditor may also have to step into the shoes of a businessman and judge that whether this is a personal expense or it is a non-business expenses. If it is commercially expediency is required to incur that particular expenditure, you may have to look into it from that. And the businessmen's assessees are the best who knows their interests best. They would not incur any particular expenditure for sake of incurring if it does not benefit their business. And therefore, it is always held by the various courts that they are the best judge to determine their best interests. Contractual obligation is not necessary for making any payment. If it is commercial expenditure, expedient, just be allowed. Onus is on the assessee to prove that it was incurred wholly and exclusively for the purpose of the business. Documentary evidence is necessary. Now, this is very important for the purpose of the audit. Let's take an example. I just get an invoice that certain services has been received. Tax services. I have chartered accountant is providing the tax services. So I raise an invoice on my client. You are the auditor of the client also. So the question is, only raising an invoice, does it mean that these services have been provided? No. It has to be a document to prove that that expenditure has been actually incurred and those services were provided. So auditor is required to look into the documentary evidence. Only because I am saying that I have raised a few bill on audit fees, would an invoice be clear? could it be claimed by an expense unless and until I've actually done the audit and there is an evidence to that effect that yes, audit was done, audit report was ultimately signed, or even if it is not signed, audit was done. So ultimately, what I'm trying to say is that documentary evidence is very important to determine the nature of expenditure, to determine whether it is a personal expenditure. Obviously, our auditing standard says that you need to have a documentary evidence. If you follow those auditing standards and if you have a proper documentary evidence, you will also be able to effectively discharge your obligations while reporting under this particular clause. If the documents are proper, you will be able to take a decision whether those are actually for the business or it is a non-business expenditure or it is a personal expenditure. So coming to a third clause, very quickly, a very small, here you need to report advertisement expenditure incurred towards souvenir, brochure, tract, pamphlet, or the like published by a political party. Section 37 subclause to be disallowed says that no deduction shall be allowed in respect of any expenditure in nature of an advertisement in any souvenir, brochure, tract, pamphlet, or like published by a political party. So you need to give a reporting over here. Once you report, obviously there would be a disallowance. It has been seen a lot of times. These are small expenditure and they are debited to a miscellaneous expenditure head, and it actually does not come into a sampling also. So the auditor needs to be cautious. He may have to go into a miscellaneous expenditure, may have to apply the sampling test, may have to look into a sampling analysis wherein all type of the figures, all type of amounts are covered, all type of nature of expenses are covered by doing a vouching. So you may actually be able to locate that is any such expenditure which is in nature of an advertisement published by a political party, then you need to report over here. There is an old 3CD, there is a circular which says, there is a judgment or guidance note also says in this regard that any advertisement given in the souvenir brochure which are published by the trade union or labor union will not be required to be disclosed in this particular. Only if it is of a political party. If the union is formed by a political party, then only you need to report under this clause. Coming to an important another clause, club services, entrance fees, and subscription entrance. This particular subclause A of clause 21 requires you to report, give the details of the name of the club, entrance fee paid towards the club, subscription expenses, and cost of club services and facilities used. So again, this is a reporting requirement. Please make a note, all the amounts mentioned over here does not necessarily results into a disallowance. So you may have paid an entrance fee, you need to report over here. Reporting over here does not mean that you need to disallow into particular expenses. A lot of people may not report over here, stating it that it is an allowable expenditure, so I need not report it over here. But you need to actually look into it. If it is in, whether it is in nature of a business or personal expenses, if it is in nature of the business expenses, you need to report over here. If it is in nature of personal expenses, you have to report in the clause in response to personal expenses. So you have to actually look into expenses in nature of the club. Whatever expenses paid towards payment to the clubs, maybe entrance fees, subscription, or the cost of services. If they are in nature of personal, I may report under the head personal expenditure. If they are in nature of the business expenditure, I will do a reporting over here. Reporting over here does not deal with disallowance. If you are reporting over here, I am not saying it needs to be disallowed. It's only a reporting requirement. There are various judgments which says that expenditure towards a club is an allowable expenditure. So what is the requirement? Whether disallowed under 37, do you actually go into that? In my view, when you are reporting into this particular clause, please do not go into disallowance, whether it is a disallowable expenses or not. You need to only give the details. You need to scrutinize profit and loss account. Any amounts debited in nature of that is mentioned in this particular clause should be reported. So any expenditure incurred at clubs, bin entrance fees and subscription, please report. Cost of club services and facilities used, please report. Details of payments made to clubs are required by tax authorities for the purpose of determining whether any portion of club expenses could be treated as participant in the heads of person concerned. So the one of the objective is also that to determine the calculation of expenses. So it's not necessarily only to determine the disallowance expenses. I've seen a lot of cases wherein we have been reporting under this particular clause, but no disallowance happens because this is not for that particular reason. Whether entrance fees, live membership paid to club is disallowable expenditure. Obviously, this has nothing to do with the reporting, only for the purpose of discussion. Any live membership paid to club is disallowable. Tax auditor to only report payment of entrance fees and not to report on its allowability. Again, I am clarifying. There are various judgments to this effect that these are the revenue expenditure, and if it is for the commercial expedient reason of the business, if it helps the businessman in growing its business by becoming a member of a particular club, it is an allowable expenditure. There are various judgments to this. Whether expenditure incurred by associate company by way of admission fee paid to obtain corporate membership of clubs, entitled it to sponsor a specific number of its employees to enjoy benefits of club, for which separate payments has to be made, and such membership allowed employees to interact with its customer. It could be said that expenditure was incurred wholly and exclusive for the purpose of business and was to be allowed as a business expenditure. So there is a Supreme Court judgment to that extent. If it is a corporate membership taken by a company which allows certain employees, maybe a directors, to enjoy the benefits of the club, it is an allowable expenditure. Similarly, subscriptions for the enrollment of directors, there's also a Madras High Court judgment to that extent. So again, for the repetition, we are only doing the reporting. There's no necessary beyond that. Then there is a 3 clauses in relation to 21 subclause A, which I'll take it together. If you see the subclause 21A, you are required to actually report any expenditure by way of penalty or fine for violation of any law for time being enforced. Then there is another requirement which says expenditure by way of any other penalty or fine not covered above. So you may have paid penalty or fine, though it may not be for the violation of law, but it is the nature of penalty or fine. You have to report in the second line. Then there is another clause which says, when I'm saying clause, this is all part of subclause A, clause 21, subclause A only. Then there is another requirement wherein you have to report expenditure incurred for any purpose, which is an offense or which is prohibited by law. So there are 3 categories which are covered, which an auditor has to report. He has to report any expenditure by way of penalty for sake of repetition, expenditure by way of penalty or fine for violation of any law for time being enforced, even not anything which is not covered above, but it is in nature of penalty or fine. Third, expenditure incurred for any purpose, which is an offense or which is prohibited in the law. So when we actually go into the judgments, we will come to know. Tax auditor, while reporting under this clause, is not required to express any opinion as to allowability again. You don't have to actually express any opinion of the amount. You have to just give the any amounts which are in which falls under this 3 particular category, and they are in nature of penalty or fine. I only need to give details. Let's take an example. I am paying any compensation or the penalty for the contractual breach, whether this would be covered. Any interest on delayed payment, whether this would be covered. To my mind, they are not covered. Any payments has to be in nature of penalty or fine. Interest on delayed payment is not a penalty. Late fee, to my mind, it is not a penalty. It cannot come under the definition of fine also. You may be paying a late fee. Late fee for, let's take an example, you are paying a late fees to an RRC. You do not file a particular requirements, particular form which has to be filed in 3 days. You file within 60 days. So you pay, for instead of 500, you may pay 1,000 rupees. The question is whether that late fee is penalty or fine. To my mind, it is not. So there are certain judgments to that effect. Payments comprising both compensation and penalty. Deduction of component which is compensatory in nature is permissible. So you may make payments. There may be some settlement which has happened between the 2 parties, and you would have paid certain compensation. Plus, you would have paid. Let's take there is an eviction suit. I was a lessee and I vacated my premises well in time, and I also stopped paying the rent because there was a dispute between the landlord and the lessee. Now the question is, after a particular, there is a settlement which is happening, or the court gives an order, and they say that you pay a compensation by way of the rent which has not been paid over a period of time, and that also includes certain other hardship compensation, and also penalty for not timely vacating the premises. So you need to, as an auditor, break up that particular payments into a compensation and penalty. Compensation is an allowable expenses. It will not find any reporting over there. Penalties only need to be reported. I'm not saying that that penalty is not allowable. As I said earlier also, the penalty, if it is because the default of the contractual payment, may be an allowable expenditure. I'm not going into that particular allowability. The question is whether I need to report over there. If it is a nature of penalty, my view would be you should report it, because it will fall under the next clause which says expenditure by way of any other penalty or fine not covered above. So in nature of penalty, it's not for violation of any law. It is not which is prohibited under the law. but it is a penalty in nature, so I am repeating it. Whether an amount paid, there's another judgment of Supreme Court, again repeating the same, that the compensatory payment is allowable under 37(1), whereas penal in nature is not allowable. So any penalty is not allowable. By stating particulars under this clause, tax auditor should also take into account consideration the concept of materiality. There's another old judgment which should be kept in mind. Any statutory impost paid by an assessee by way of damages, penalty, interest is claimed as an allowable expenditure under 37(1) of the Act. The assessing authority is required to examine the scheme of the provisions of the relevant statute providing for payment of such impost, notwithstanding the nomenclature of the impost as given by the statute, to find whether it is compensatory or penal in nature. So what does this Supreme Court says? I may pay some penalty under a different law. It may be termed as a penalty. What does the Supreme Court says? You have to actually go into the provisions of that particular act and determine, though it is the name nomenclature word is used as a penalty, but actually in the real sense, whether it's a penalty or it's only a late fee, it's only a damages, or it is only an interest. So there may be a penal interest also. You may be, for making a delayed payment under a particular law, you may be paying a penal interest. If you pay within 6 months, you pay 18%. If you pay after 6 months, you pay additional penal interest. So you're paying 18%, but you are paying another penal interest of say 6%. Now the question is whether this penal interest is in nature of penalty or it remains interest. So that view needs to be taken. The Supreme Court says for purpose of even allowability under 37(1), you actually need to go into the act or the law, under which this penalty or interest has been paid, and you need to determine whether it will be covered, it will fall under section 37(1). It would be in nature of penalty for the purpose of the Income Tax Act, and whether it would be allowable or not. If the amount so paid is found to be not a penalty, again a Supreme Court judgment, or something akin to a penalty, even though called penalty, then one has to regard such payment as a business expenditure of the assessee, allowable under section 37 as an incidental to business, laid out and expended wholly and exclusively for the purpose of business. But as an auditor, the question arises whether I need to do it. If it is a penalty or fine otherwise, may not be disallowable, may not be in the nature of penalty. My view would be, you may not report, those certain guidance notes says that it's my personal view, please mind it. If it is not in the nature of penalty, and if an auditor could actually go into the law and take a legal opinion in that particular case, that no, it is not in the nature of penalty, though it is called as a penalty, then you may not do it. But if it is reported as penalty, I may not be expert of the other law. So I would not be in position to take a decision. If it is termed as penalty, as a matter of abundant caution as an auditor, I will report under this particular. I may request management, you may take a legal view and claim as an expenditure in your computation of income, but I may not be an expert of other law to interpret whether it is in nature of penalty or not, which may be allowable under section 37. So that could be a fine view as an auditor and the balance to safeguard our interests also. We have already discussed. Then there's a CBDT clarification which should be kept in mind. It's an old clarification of 1998, which says, after amendment in section 37 in 98, will result which says that any payments made by assessors in respect of protection money, extortion, hafta, bribes, etc. as a business expenditure. It is well decided that this is an unlawful expenditure, is not an allowable direction in computation of expenditure. So it is an unlawful expenditure. It is an expenditure which is prohibited by law. Paying haftas, bribes, extortion. So obviously you cannot claim this as an expenditure. So it is not allowable. Any expenditure in consequence of violation of law, like penalty or fine levied for evading provisions of FEMA, excise, etc., cannot be claimed as deduction under the Act. A penalty imposed for violation of any law during the course of trade cannot be described as a commercial loss. Even if the need for making payments has arisen out of trading operations, payments are not wholly and exclusively for the purpose of the trade, and therefore it is not disallowable. You may have to report penalties paid under FEMA law, excise and customs law. They are in nature of penal. You will have to report it. So whenever the auditor can actually go into that particular law and determine that yes, these are in nature of penalty, please do mention over here. If you are not able to go into particular law, if you are not able to determine, you are not in a position to determine whether those is a penalty, they are only called as a penalty, but they are not in nature of penalty, you may rely upon a third-party legal opinion. Or you may report over here and you can take tell a management whether to claim as an expense or do not, does not does not mean that I have reported you may not claim an expenditure. You may still continue to claim an expenditure. Now I will move to subclause B very quickly. See, subclause A was important. Subclause B is also important. It deals with basically disallowance under section 40 subclause A, which is a very important. It is applicable to practically all the assessors. Under this subclause B, there are 7-8 different portions where you need to report. You need to report whether there is any disallowance required under subclause section 40 subclause A under the following heads. Any payment to a non-resident, which is referred to in subclause 1 of 40A. When I'm saying subclause 1, now I'm referring in this particular slides on the screen, I'm referring to clauses of the sections and not the clauses of the clauses of our Form 3CD. So you need to report on any disallowance under subclause 1, which is in regard to payment to non-resident. Then any payment to a resident, wherein no TDS has been deducted, you are well aware. In regard to fringe benefit tax, wealth tax, royalty or license fee, service fee paid, which is disallowed under subclause 3(2)(b) of section 40 subclause A, salary payable outside India to a non-resident. This is only an overview of section 48 of the clause 21 subclause B of Form 3CD, which deals with disallowance under section 48. These are the way overview wherein you need to report. I'll go slide by slide. This is only an overview of that particular slide. Any payment to a non-resident referred to in subclause 1, reporting needs to be done. Details of payment on which tax is not deducted. You need to report over here, date of payment, amount of payment, nature of payment, and name and address of the pay. Details of payment on which tax has been deducted but has not been paid during the previous year needs to be reported. The reporting is fine. There's no problem. The question may arise under the subclause A, the first portion, wherein details of payment on which tax is not deducted. And this is in regard to payment to non-resident. Now the question will arise, who is going to determine whether the tax is applicable? Is it we need to determine? Does it any reporting over here means yes, there is a disallowance? Yes. When you are reporting any, because if you read the clause, starting is amounts inadmissible under section 40 subclause A. So here you have to actually report inadmissibility on. You need not report any amounts which are otherwise on which tax should have been deducted and you have not deducted. Sorry, there was no requirement of tax deduction on that. You come to a conclusion section under 195, there's no tax required to be deducted, it will not be reported. Only if tax is required to be deducted. So the auditor will have to go into the provisions of this section 195. Will have to determine whether the income was taxable in case of non-resident, taxable in India. What would be the tax rate applicable? What are the provisions of DTAA? And if the auditor comes to a conclusion that yes, tax was deductible and on which no tax has been deducted, a reporting needs to be done. So only those cases, not all cases, wherever tax has all the payments to a non-resident, wherein no tax was required to be deducted, need not find a place over here. How would you do this? Obviously, when I go into this, I will also go into the procedures. First, I will cover what are the form requirements. Then the subclause 2 of the form says payment to a resident referred to in subclause 1A, details of payment on which tax is not deducted. Please keep it in mind, the amounts reported here has to be synchronized with their clause wherein you are reporting the details of tax deducted. When the chapter 20, wherein I would be very specific clause, wherein the details on which tax was required to be deducted and not deducted needs to be deducted. Provisions of chapter 17 we are reporting, that is clause 24 of the tax audit. Now there has to be a synchronization with clause 34 of the tax audit and the reporting under this. So in clause 34, when you are reporting, you are giving the details of the total expenditure incurred, reconciliation on which tax had to be deducted, on which tax has been deducted, on which tax has not been deducted. So tax was required to be deducted, but not deducted will find a place over here. And this has to be reconciled. Please keep it in mind. That's the most important caution which I would require to bring it out over here. Details of payment on which tax has been deducted but has not been paid during the previous year or in subsequent year before the expiry of time prescribed under section 201. So the first clause is where tax has not been deducted, and second case where tax has been deducted but has not been paid well in time. Now it's very important over here that all non-deduction may not result into 40 disallowance under 40A. So we'll go into that provisions. There may be a case where you are not an assessee in default. You are not an assessee in default if the recipient of the amount has already paid tax on it, then you are not an assessee in default. And that is under section 20. then there would be no disallowance under section 48. So in all cases, this reconciliation may not directly tell you that I was required to deduct a tax. I'm not deducted. So there's a reporting happening in clause 34. That does not mean disallowance will happen. For the purpose of disallowance, I should be assessing in default. If I'm able to prove that the tax has been paid by the recipient of the money, by the payee, then there is no problem. Then you have to report some paid on account, disallowance on account of fringe benefit tax, on account of wealth tax, which are both are irrelevant now. Practically, it's not applicable, I would say. On account of royalty, license fee, service fee, which is appropriate service charge, which is under subclause 2B of section 40, subclause A. Salary payable outside India to a non-resident without TDS under subclause 3. Obviously, again, if the tax salary payable outside India, taxable in India, and tax was required to be deducted but not deducted, would form here. Payment to PF or any other fund established for the benefit of employees of the assessee, unless assessee has made effective arrangement to secure that tax shall be deducted. 7. Any tax actually paid by an employer referred to in clause 10cc of section 10 under subclause. So these are the important points which needs to be reported. Now, my concentration is on 40A subclause 1, very important. What are the conditions as per section 201? Important. Assessee shall not be treated as assessee in default. See, disallowance under 40A is there when there is assessee in default. So you need to refer to the provisions of section 201. If your client is an assessee in default, then only disallowance under section 40 subclause A will be reported. So there may be a non-deduction of TDS reported in clause 34. Again, I am repeating it, but there may not be a disallowance under section 40 subclause A. You need to do a reconciliation as an audit. What is the amount reported over there? Those amounts need to be tested from a perspective of section 40 subclause A. Whenever there is no assessee in default for which you have a documentation to be taken from the pay, assessee is required from an accountant of the pay that he has offered for taxation in form 26A, then you may not disallow because he is not treated as assessee in default. Assessee in default, he will not be treated, pay will not be treated if payee has furnished return of income, has taken such income paid by your client to a payee, has been taken in the computing income and has paid tax. If he has paid tax, then he is not an assessee in default, no disallowance under section 40A. Auditor will have to obtain required assessee to get a certificate from accountant of a pay in form 26A, showing that he has paid, he has included in computing income and have paid due tax on it. So that reconciliation has to be done. Then there are certain judgments which needs to be kind while calculating amounts inadmissible under this particular clause. It was held only when there is no deduction, then the section 40A applies. In case of a short deduction, there cannot be a disallowance. So short deduction again reported under clause 34, but no disallowance. There are judgments to deduct. If I instead of a 2%, I deduct 1% contractor, I do a mistake, it's a genuine mistake, there cannot be a disallowance because tax has been deducted and deposited. If payer has taken such income, which I have already discussed, while computing total income and has paid tax thereon, there would be no disallowance. TDS shall be deemed to be deducted if payer has disclosed the income. This is the provision. Basically, there's no default under section 201, so there is no disallowance. Surcharge on sales tax or turnover tax paid by associates to government is not a fee or charge coming within the scope of 40A, subclause 2B. This be kept in mind. This will not be allowed under subclause 2B. No disallowance required. High Court by impeach order held that where assessee had deducted tax source from salary paid overseas to its non-resident employees and has paid same to government account merely because tax was not paid within time limit prescribed under section 201, said payment could not be disallowed by invoking section 48 subclause 3. Special leave petition filed against repeater was been dismissed. So Supreme Court has dismissed the SLP. So the High Court judgment in case of ANZ has allowed. So in case of a non-resident, only in case of salary, if the tax was deducted and it was paid, only it was not paid within the time limit prescribed under section 200, there cannot be a disallowance under section 40A. Whereas subclause 3, but in the subclause 1A, if it is not paid within time limit, yes, disallowance is there. It's not a permanent, it will be allowed in the subsequent year. Please mind it, you have to report amounts inadmissible over here. As you are well aware, under section 48, disallowance is only 30% of the amount now. Not earlier, which was 100%, but when reporting in clause 21 subclause B, you have to report 100% amount. You have to record what is amount inadmissible to that extent. So you will calculate 30% to that, and you will say this is the amount inadmissible. There's one question which I thought would be relevant, whether that would be a disallowance under 48(1)(a) for non-deduction of tax when income is declared under 44(a)(d) or (a)(d). This is not relevant to an audit. 48(1)(a) does not apply to a living provisions of 44(a)(d) where the presumptive taxation is wrong. These are the judgments. I thought I'll just bring it, though it's not relevant. Similarly, when the capital expenditure is incurred, shall be reduced from the actual cost of capital asset was not deducted. There can be a disallowance for claiming for a disallowance amount inadmissible. It should be a revenue expenditure. So the question arises whether the 30% of expense is required to be disallowed if tax is not deducted, if it is in nature of capital expenditure. There were judgments to that effect that only from an expense which is claimed in profit and loss, a disallowance can happen, not from a capital expenditure. But this position has been reversed after the amendment made, which says that now the proportionate depreciation should be disallowed in case there was no TDS deducted on the original acquisition of the capital asset. So what the tax auditor must do, please keep this in mind. Tax auditor should obtain in writing from the assessee the details of all payments debited to P&L. Check for actual remittance made overseas by assessee during the relevant previous year. Check whether tax is deducted or not. Reliance upon the legal opinion or certificates from CAs who are issuing 15 CB, based upon which remittance have been made without deduction of tax. Yes, you can, if another chartered accountant has issued 15 CB certificate stating that no tax was applicable, you can actually rely upon that because it is ultimately you're relying upon the third party opinion. It's not compulsory that you should not rely upon that. You can still do that. If you still doubt as an auditor, you may also take another third party opinion and then go further. Refer the applicable double taxation avoidance agreement. In case of no remittance, check whether any amount has been provided in the books. In case of disagreement on tax withholding, same may be specified in the report. So in case there is this, you have to give your report. As I said, if according to you, there was a tax deductible on which tax has not been deducted and it is disallowable under section 40A, you should disallow. You should mention in this particular clause. If the management is of the view, they are not agreeing the view, they may not disallow in the computation. There may be difference between the computation and all this. 1 second, I'll just take a sorry. So your job is to report it. Even if the management do not agree, you will have to report it. If management do not agree, he may not reduce it from its computation of income. He will continue to claim it. There may be a dispute. He may go into the appeal. As an auditor, if your view it was tax deductible and therefore it is inadmissible, the reporting should be done. Then we will move to another clause, subclause C of 21, which deals with amount debited to profit and loss account, bin interest, salary, bonus, commission, or remuneration inadmissible under section 40 subclause B, 40 subclause BA, and computation thereof. Now, this clause requires you to report the salary, bonus, commission, or remuneration paid to a partnership firm. Now, 40 subclause B only applies to firms and LLP. And you have to report and look into it, the provisions of the section. According to section 40B, the interest, salary, bonus, commission, or remuneration would be allowable unless the following conditions are satisfied. Would be not allowable unless the following conditions are satisfied. Remuneration is paid to working partner. Remuneration on interest is authorized by the partnership deed and is in accordance with the partnership deed. Remuneration or interest does not pertain to a period prior to date of partnership. So the auditor needs to verify that these conditions are satisfied. If these conditions are satisfied, it is an allowable expenditure. Again, while reporting in this clause, you have to actually calculate inadmissible amount. So if the partnership deed says 9%, interest will be paid at 9%, whereas the interest has been paid at 12%, then it is not in accordance with the partnership deed. So auditor will have to report 3% in response to this particular clause, because though 40B prescribes the maximum rate of interest at 12%, it is allowable, the maximum rate of 12%, but the partnership did only prescribe 9%, then it would be only allowed up to 9%. If it is paid 12%, debited to P&L 12%, 3% would be disallowed, auditor will have to report. If it's a vice versa, the partnership deed says 15%, they are paid 15%, then also 3% would be disallowed over here, because partnership deed don't prescribe 15%, but there is a capping of 12% under the provisions of the law. So you will have to go by that. Remuneration, if it is paid to a working partner, if it is paid to non-working partner, it's not allowable, so it should be disallowed over here. It should be maintained. Whatever amounts have been paid, either as the interest, salary, bonus, commission to the partners under Section 40B, it should pertain to the period which it pertains to, for to which this partnership deed is applicable. It should be only to that extent. The formula, I'm not going into formula, I'm just moving it ahead faster. Section 40BA is in regard to AOP. 40B subclause B was in regard to firms. This is in regard to AOP. In case of AOP, if you go any interest, this is only applicable to association of persons and BOIs only, and to their members. So any interest paid to members of the AOP or BOI, they have to be disallowed. Net amount has to be disallowed. So if it is some amount is paid, some amount is recovered, net will be disallowed. Similarly, if any amount is paid towards the remuneration, remunerates include salary, bonus, commission, by whatever name, paid to the members shall be not allowed. So the reporting under this clause will happen. Now this is very important. When a deposit in firm was made by a HUF, so HUF of a partner, where the partner is Karta, he has deposited certain sum with the partnership firm, and you are paying certain interest. Whether the provisions of subclause 40B will apply, it will not apply. It may be treated under the relative, 42AB may be applied, but 40 subclause B is specifically only to the partner. HUF cannot be treated as a partner, so there's a judgment to that effect. Similarly, of Supreme Court, old judgment is there. When the firm paid interest to partners or capital contributed by them and received interest from partners on borrowings made by them, this transaction has an element of mutuality and were referable to funds of partnership as such, thereby making only excess interest paid by the firm liable to disallowance. So netting has to be done, and any amount which is paid in excess of that only would be disallowed. Interest on funds borrowed for investment as a capital in a partnership firm are deductible expenditure. Now, this is from a perspective of a partner. So if he is paying if he has incurred any expenditure for contributing to a partnership firm and is receiving an interest on that partnership firm, that would be allowed as a deductible expenditure under the head PGBB. Please keep it in mind, interest received from the partnership firm is taxable under heads, profits and gains of business and not income from other sources. Now, for making that capital investment into a partnership firm, if an individual incurs any expenditure, obviously that would be allowed under the head PGBB. Similarly, any expenditure other than interest also is incurred by the partner for earning income from partnership firm is an allowable expenditure, not the profits. So if any expenditure is incurred, which is very important, let's take an example, you are employed, you are earning a remuneration from a partner, which is taxable in the hands of the individual partner, because it's allowable under Section 40B. The question is, for earning that remuneration, if you have incurred expenses by way of vehicle, conveyance, all those would be allowable as an expenditure in the hands of the partner. This is referring to partners, not relevant for the firm. Please keep it in mind. Where the firm has paid remuneration to partners and said amount was taxable in the hands of the partner, disallowance of said amounts in the hands of firm would result in double taxation. Therefore, disallowance in case of firm was to be deleted. This is a very specific judgment wherein obviously the limits of 40B will apply, but it cannot be otherwise disallowed because it will result into a double taxation. Now, while calculating a tax under 40B, you need to keep it in mind that the slab is given based on the book profits and not on the basis of taxable profits. If I'll just go to the previous slide for calculating remuneration allowable, you need to calculate on the basis of book profit and not on the basis of taxable income or the gross total income. You have to calculate on the basis of book profit. So the question arises, for the purpose of the book profit, whether interest earned by the firm on fixed deposits, because otherwise those interest is taxable under income from other sources. What should happen? Whether this should be considered while arriving at the book profit profit for applying the formula of allowability of the remuneration. According to me, it could not be excluded. But whatever is the profit, it may be taxed under whatever head, it will be forming part of the book profit. And based on that book profit, the remuneration allowability ceiling has to be considered. When a supplementary partnership deed specifically mentioned about payment of bonus by assessee partnership firm to partners and also specified exact amount of bonus payable to partners, payment of bonus made to partners was in accordance with partnership deed and authorized by same could not be disallowed. This is Delhi Tribunal. Then there is again, we have already discussed in the case of HUF, important judgment. Any payment of interest by a firm to any partner of the firm, in our view, must include the payments made directly or indirectly to any partner who is the partner in case of an HUF. Karta representing HUF is a partner notwithstanding the term. So it's a contrary judgment which we have discussed. But my view remains no. It cannot, 40B cannot be covered under that. Amounts inadmissible under section 40A3, which deals with the cash payment in excess of 10,000 or by a manner other than account pay, which needs to be reported. Again, over here, amounts inadmissible has to be reported. It's not a reporting requirement. If it is disallowable, you need to report over here under subclause 3 and subclause 3A of section 40A. So these are the formats. I'll move ahead. Rule 60D provides certain exceptions to it, wherein even if the cash payment is made in certain cases, it is permissible. So no disallowance will arise in particular case. Payment to specified entities engaged in banking and insurance. So if the payment is made to banking and insurance companies, where paid to government, where the legal tender is compulsory, payments to banking channels with the use of bill of exchange, book adjustment transfers, specified growers and cultivators, generally applicable in the agricultural community, cottage industries, payments in the village not served by a bank to resident of such place, payments of specified terminal benefits to employees up to 50,000, payment to agent who is required to make payment in cash, payments by authorized dealer for purchase of foreign goods. So these are the exceptions wherein the provisions of section 40A subclause 3 does not arise. In case the payments are made for the particular purposes, then there is no disallowance. Otherwise, inadmissible amounts needs to be reported. Now, very important, where the assessee incurs any expenditure in respect of which a payment or aggregate of payments made to a person in a day in a cash exceeding rupees 10,000, no deduction would be allowed. This is the provision of 40A3. In case of payment made for flying, hiring, or leasing of goods, limit is 35,000. Tax auditor is suggested to obtain a suitable certificate from the assessee for the payments of expenditure under 40A3 and 40A3A when made by account paying check. So we generally have our guidance on formats. You may please refer to that. That I cannot, the format has been given which says you may give a disclaimer. It is not possible for us to verify whether the receipts, payments have been accepted, made otherwise by an account paying check on an account pay bank graph. In view of the large volume of transactions where it is not possible to give individual items of inadmissible items, the tax auditor may furnish such details under broad heads of accounts. Item of expenditure in respect of which specific exemption is available are not required to be stated. So, what does the expenditure incurred? I will just move it a little faster, next 5 minutes, and then we'll take the questions. It means all outgoings are brought under the word expenditure for the purpose of section. I have just brought in for the purpose, obviously, my presentation, I will request the committee to share with the participants. So there are certain judgments which I have kept it in my presentation only for the benefit of participants for the subsequent reference. I may or may not discuss. There are judgments in next 3 to 4 slides which says what is an expenditure. It's important for an auditor to determine what is an expenditure when he wants to report inadmissibility under section 48. There are various judgments, including Supreme Court, various high courts, wherein it is said that the purchase price paid for the goods is included in expenditure. So this has been taught. I'll go to next clause, amounts of inadmissible under section 40A7. Provision for payment of gratuity not allowable under section 40A7. You need to report any payments made to for a gratuity which is not allowable under 40A7. What does the 40A7 says? Provision for the payment of gratuity shall be disallowed except payment of any contribution to an approved gratuity fund, payment of any gratuity which has crystallized during the previous year. So if it has crystallized during the previous year, it is allowable. Or if it has been paid by way of contribution to approved gratuity fund. So your gratuity fund, the assessee who is making any contribution to the gratuity fund should be approved under the Income Tax Act. Then only it would be allowable. If it is not approved, and then if any contribution is made to a fund which is not approved, it would be inadmissible, which requires a reporting over here. A provision, payment of gratuity crystallized during the previous year. What is provision? Provision is an appropriation of money for a known and existing liability. It is not necessary that such liability is quantified, but it must certainly be a known and existing liability that has become payable during the previous year. Then only it will be allowable. So it should be a provision. Provision should be done. Liability should be quantified. It should have been crystallized. Then it would be allowed. Where assessee, education, charitable trust made provision on account of gratuity on actual basis. As we all know, there is an actual valuation done. AS 15 also, accounting standard 15 also says that actual valuation should be done and the provision for the gratuity should be made. If the provision has been made according to that, then it is an asset and liability. Then only because the provision has been done, it cannot be disallowed. Any sum paid by an assessee as an employer not allowable under section 48(9) requires a disclosure under this particular point. You need to look into it. Again, the provision needs to be made. Any contribution made to employees' welfare cooperatives will not be allowed as a deduction. It has to be again a recognized PF or approved superannuation fund, notified pension schemes, or approved gratuity fund. Only on such expenses it would be allowed. There's a judgment of Wipro, which is relevant. I thought it should be covered over here. Company constituted a deferred compensation plan for its employees. Under the said plan, assessee contributed a proportion of basic salary of employee to a guarantor trust, which was released to employee on his separation from the company. It then claimed deferred compensation amount paid to employee through trust as expense under section. Tribunal disallowed claim of assessee on the ground that trust did not fall within parameters of 36.145 with 48(9). However, as per judgment of Wipro Limited, claim of assessee under 37(1) could not be disallowed by Wipro. So it will be allowable. See, any disallowance under 40A subclause 9 does not specifically means that could be a disallowance under 37(1). Then assessee may still claim under 37(1) if it is for the purpose of business expediency. What an auditor is concerned, whether it is allowable under 48(9) or not, that needs to be kept in mind. And therefore, you need to look into the provisions of 48(9), whether the conditions prescribed under 48(9), whether it is to recognize PF, approved superannuation fund, notified pension scheme, then only it would be allowed, or it may not be allowed. So I'll skip this, go to further. I'm not going into this judgments. There may be many on 48(9). Now, this is the last 2 slides. I'll try to cover very quickly before we go to the questions. 21 subclause G, particulars of any liability of the contingent nature. Auditor over here is required that any liability which is of a contingent nature, which is dependent upon the future events, should not have been debited to profit and loss account. It should come as a contingent liability. If it is not coming as a contingent liability, but it is debited to P&L, auditor is expected to just make a disclosure in response to this particular process. So you should be, as an auditor, you should be mindful of a distinction between contingent liability and the provision. Provision is when it's a crystallized liability, you will make a provision for that outstanding. But if it is a contingent liability, you will not make a provision. There would be a disclosure in the accounts that it's a financial statement that this is a contingent liability in accordance with my accounting standards. You also need to refer to the accounting policies adopted by the SSC to determine and mention in the financial statements. Tax auditor should check whether the contingent liability disclosed in the earlier years have been provided in the books of accounts and relevant previous year. If yes, then the basis for the provision of this. So the management will have to take a view that the contingent liability has now been crystallized and I need to actually make a provision. Then obviously reporting will not arise. But if it continues as a contingent liability, but the management makes a provision to claim the tax benefit, then definitely you may have to report over here. So auditor needs, and again, as I said earlier, there may be 2 views. A statutory auditor may view it as a provision is compulsory required because the outcome is more probable against the particular assessee, and therefore he would have made a provision. But still a tax auditor may feel, as an expert of tax or an expert of the law, you may feel, or you may have a third-party opinion whereby it has been said, you have a view that it's more probable that yes, expenditure would be incurred. It's not a contingent. The chances of losing a particular case is more in the against the SSC, then you may make a reporting over here. Auditors need to look into the contingent liabilities shown in the notes to accounts is not required to be reported. Only amounts which are debited to profit and loss account needs to be. You should be also aware of the provisions of ICDS when you are reporting in this particular cost. I'm just giving a small example of the judgment in case of Sodexo India of a Bombay High Court, where an assessee in Form 3CD disclosed amount of contingent liability at rupees 42.94 crores. And AO, while making adjustment under 143.1 under the head amount in income tax return, reflected figure of 0 instead of 42.94 crores. Assessing officer was directed to pass a speaking order with respect to amount of 42.94 crores. So there is a difference between the amounts reflected in income tax and amounts reported under this particular clause, and addition was being made. Bombay High Court said you pass a speaking order. So only there is a difference. Everything which is reported over here does not mean there is a disallowance. 143(1) should not trigger in all particular place, and therefore auditor should not be concerned what will an AO do. If he feels it's a nature of contingent liability which has been debited to P&L, he should report. That's what auditor's duty is. Again, I will just quickly move this judgments on contingent. I'll come to the last clause, 21H. Amount of deduction inadmissible under section 14A needs to be reported. In respect of what is 14A, any expenditure incurred in relation to income not includable in total income. So if any income which is earned, which is exempt and not included in total income, any expenditure incurred in relation to that income is not allowable, which needs to be reported in response to this. For the purpose of section 14A, what are the various conditions which an AO needs to do? I thought it would be appropriate to bring here. AO needs to be satisfaction of assessing officer is must as to correctness of claim of assessee. No disallowance of interest where sufficient own funds are available. Net interest to be considered. Interest received, interest paid to be netted for the purpose of 8D. Investment from which no exempt income has been earned should not be considered for purpose of Rule 8D. No disallowance can be made if no exempt income is earned during the year. So this is the summary of the judgments in respect to section 14A for the benefit of the members while reporting this. Tax auditor is required to report the amount of expenditure incurred by an assessee in relation to an income which is exempt. Should examine whether the details of amount of inadmissible expenditure as furnished by assessee. While carrying out such examination, tax auditor is entitled to rely on the management representations. Tax auditor will verify the amount of inadmissible expense. Now again, here you are reporting the disallowance figure. Again, management may agree or may not. Any reporting over here does not mean that management has to disallow. I may report a calculation. A lot of people are doing a calculation of 8D and reporting under this clause. Though I may have a different view, whereby I feel that if an auditor comes to a conclusion that there is no exempt expenditure incurred for earning the no expenditure is incurred for earning the exempt income, there cannot be a disallowance. And applying Rule 8D is the job of AO and not the job of the auditor. I have to give a satisfaction. If I am satisfied that there is no expenditure incurred for earning the exempt income, I may not report anything under this. So this is only calculation. I'll just move it faster. The last is 21I, disallowance under section 36(1)(3). Any interest is inadmissible if interest is paid in respect of capital borrowed for acquisition of asset, that is capital expenditure, and interest paid for the amounts borrowed towards acquisition of capital asset, extension of existing business, for any period from date of borrowing till date of put to use of assets. So all these are disallowable expenditure. Auditors is required to look into the provisions of 36(1)(3), check the interest computation. If any interest pertains to a loan which is utilized for the purpose of any of these three items, disallowance needs to be reported. You also need to look into principles of AS 16, which does with the borrowing cost. I'll just quickly try to complete this. Thank you very much. We can take the questions now, Anita-ji. I thought I'll quickly encode. It's 7:43. Thank you very much for your patience hearing, Anita-ji. If we can take questions.
Thank you very much, sir. You have very exhaustively covered clause 21. And some of the questions have been replied in your presentation also, sir.
Yes.
We will take some of the questions which were not addressed, sir. For example, what is the reporting relationship between clause 21B and clause 34A? One of the members have raised this question, sir.
So 34 is in relation to TDS and 21 subclause B is in relation to disallowance under section 48. During my presentation, I was trying to get that auditor needs to reconcile that. So whatever you are reporting under section 3, clause 34 does not mean that it would be disallowed under section 40 subclause A, and therefore it will find place in response to this particular clause. There may be a situation where tax was required to be deducted and you have not deducted, you will report in clause 34. But because the assessee is not treated in default, you get a certificate from the payee that yes, I've included in my computation of income, I paid due tax on it. So there cannot be, my payer cannot be treated as assessee in default, and therefore there would be no disallowance. So that would not find in the clause, in response to clause 21 subclause B. So that, but as an auditor, you need to reconcile both the figures. That how I have come to this particular figure, why it is not reported in 40 subclause A, and you should have a documentary evidence of it. That though there is a default in tax, but there is no disallowance under 40 subclause A, and that's a documentary evidence of it. Thank you.
Thank you very much, sir.
Sir, another question we have received. A viewer asked provision reporting in clause 21G. He is asking provision reporting in clause 21G related to contingent liability.
Correct. Contingent liability, I was just briefly, of course, I had quickly tried to cover it in the last session, basically. Because it was in the last one. The question is, and a statutory auditor may report certain amounts as a contingent liability, and the management may not agree, or the statutory auditor vice versa would say that there is a provision required because the probable outcome of a particular, let's take an example, there's a dispute with the income tax department or the GST department on the applicability of the tax laws, and the auditor insists that you should create a provision of it. So auditor makes a provision in the books of accounts, and it does not show it under the contingent liability. But a tax auditor has a different opinion to it. He may take a separate legal opinion and state that no, the probable outcome of a particular dispute may be in the favor of the assessee, and therefore the provision should have not been made. It is in nature of more in the nature of contingent liability. Then you need to report into this. So it's basically a situation may not arise in a case where you are the statutory auditor also and tax auditor also. So wherever the provision is made, sometimes what the management does is only to take a tax benefit, they may make an ad hoc provisions, which is not earmarked to any particular expenditure also. I just make an ad hoc provisions. There is no liability crystallized. Though there may not be in the contingent nature, but these are ad hoc provisions. Auditor may have to take a judgment whether this ad hoc provisions, which is otherwise not earmarked to any particular expenditure, there is no liability incurred, there is no crystallization of liability, whether this would be allowable or not, and it should be reported over there.
Thank you very much, sir. There is another question raised by a member that for clause 21E, if we are maintaining gratuity through trust fund or LIC, do we need to report it under Form 3CD as disallowance?
No, if it is paid to if you have an approved gratuity trust and you are making the payment through an approved gratuity trust to an LIC contributing, then there is no disallowance. So there is no need of maintaining. You need to only mention amounts inadmissible under section 40A subclause 7. If it is not inadmissible, you need not. And since you are contributing to an LIC group gratuity, let's take an example. It is an approved scheme. You should have a gratuity fund for that as an employer. If an employer has an approved gratuity fund, any contribution made to an LIC directly, actually it should go through a gratuity fund. You should deposit with gratuity fund. He should contribute to LIC. But if you are directly making through an LIC also, then also it would be allowable.
Sir, another question is, do late fees or interest required to report in clause 21A
according to me,
penalty?
According to me, no. According to me.
Okay, sir. Another question.
As I said earlier also when I was discussing is you need to look into the provisions of the relevant act under which it is paid. But late fee per se by the nomenclature is not a penalty, I would say.
Okay, sir. Another question is how to verify transaction under section 40A3 or 3A?
40A3A, when I was going through my slides, as I mentioned, you will actually have to look into it through your analytical skills. You will have to go through all the ledger accounts. Now, 40A3, as far as whether the check amounts have been paid through an account paid check, we are already giving a disclaimer. As far as cash is concerned, obviously you can go through the cash book, whatever the payments have been made through the cash book and debited to expenditure. You need to sort it out and verify that. Or you will have to go through the vouchers and see that whether they are exempted under Rule 60. If they are not exempted, then the disallowance will come. If they are exempted, then no disallowance will happen.
One last question, sir. Whether compounding charges under FEMA is a penalty? It's a general question being raised by a member. Whether compounding charges under FEMA is a penalty?
You will have to refer to a FEMA Act for that purpose. Obviously, I'm not very sure, but actually it's not compounding charges. It's called compounding fee under the FEMA. Like income tax also says the compounding fee. Obviously, any amount paid under the Income Tax Act is not allowable. So when it comes to an income tax, though it is not penalty or fine, it is not allowable. But when you're paying compounding fee under the FEMA, it is not under the nature of the penalty. You are actually compounding the penalty or the prosecution, which otherwise would have been attracted under FEMA to best of my knowledge. So to my view would be, it should be allowable and it should not be disallowed and not mentioned in the tax audit. My view would be that.
Thank you very much, sir. Your session was really very interesting. For only clause 21, we have talked for so many things, and I hope and I'm sure that the members would have benefited. The intricacies and particular of clause 21 has been deeply covered in your presentation, sir. Thank you very much. And we are very happy to inform you also that more than 1,500 participants have joined this webcast.
See, what I had done is, Anita ji, because it was quite lengthy, I have gone fast also at certain places. My only request is you can share my presentation with all the participants.
Absolutely, sir.
Details about it. Because there are a lot of judgments which are relevant for them when they are actually doing an audit. You may not be, I may not have been able to discuss in the short period of time each and every judgments, intricacies of that. So it's important, it's only for the purpose of referral whenever they are doing it an audit. That's all.
So we will upload your presentation in a resource section of our TAQRB, and that would benefit the members also. Thank you very much, sir.
Thank you. Thank you very much.
Thank
Thank you
you.
very much for
Thank you, Ali.